Good morning, everyone. An eventful weekend with some additional conflict in the Middle East. We hate to see this between Israel and Iran. Matt, I want to talk to you about that. The energy market's probably taken the most direct result from that action. So, what can you tell us about your thoughts on what this may mean to the energy markets at the present time?
Well, Steve, that's a great question. And let me tell you, I've followed the energy markets for about 25 years, 30 years in my career. And I can tell you that unless there's actual physical stoppage of oil, I think much of the rebound that we saw in Friday and over the weekend will probably run back out of the price. I mean, we saw prices go as high as $77, $78 Brent, and that's pre the attack from Israel to Iran. Prices were in the low 70s and high 60s, and I think we head back to that range. Now, the concern that investors have is that about 20 million barrels of oil flow through the Strait of Hormuz, which is in between Iran and essentially Oman. And if that strait has disruption to it, that would drive oil prices quite a bit higher. But right now, I think investors are taking a watch and see attitude. Oil markets have been volatile, but frankly, unless there's a change to the actual supply of oil coming out of the Middle East, I don't think it'll have a long-term impact. The other big event, though, Steve, this week is the Fed meeting. What are you seeing on that front?
Yeah, the FOMC meeting, which this is, again, this is just yet another reason why the Fed needs to be a little bit careful, right, Matt, about looking at changes in monetary policy, not just because of all of the moving parts that we have within our own economy with tariffs and what Congress is doing from a tax policy standpoint, regulation, what that may mean to growth. Anytime you see this type of volatility in the energy markets, which we know the Fed backs food and energy out when they think about monetary policy, but energy prices have a way of working their way through the entire economy. So at this point in time, look, I don't think anything that's happening. We got good news out on inflation last week. CPI and PPI, the trend in inflation was going the right direction, but it's not enough for the Fed to think that they need to ease monetary policy at this point. So look for no change in rates. The bigger thing that I'm looking for, Matt, is the outlook from the Fed and their statement of economic projections, not just what they may do between now and the end of the year, but maybe where they're thinking about interest rates in the long term, what the neutral rate of interest rates are for the economy. That's been moving up a little bit. In the end, we still think the Fed probably has some room to ease over the next few months, but we don't want an aggressively easing Fed. That would be a bad economic outcome, and we just don't want that. Matt, I want to come back to you, though, real quickly on one thing. Oil markets versus natural gas. Any shift to the idea that this is a real positive environment for the globalization of natural gas?
Steve, I've mentioned the globalization of natural gas for the last few years, and I still think we're on track to see that. I will tell you that some of the attacks from Israel on Iran did target natural gas resources in Iran. So if anything, the market is going to tighten globally, which is good for us. We're net exporters of LNG. And so as the market tightens, we'll see improved pricing for our exports of natural gas. So that's the only real impact I see on that. But I still believe that we're going to see the commodity globalize over the next few years, particularly as we build more export facilities here in Australia as well as Qatar.
Thank you, Matt. Thanks, everybody, for dialing in. We'll look forward to having another conversation with you in the coming weeks.